Good morning, everyone, and thanks for joining us. My name is Kerry Kantin. I'm the U.S. Bureau Chief for LevFinInsights, and I'm joined today by Jessica Reiss and Scott Josefsberg, who are co-heads of research for leveraged loans and high yield, respectively, for Covenant Review. Last time you all joined us, we were coming off of March's volatility with the start of the Iran war, but the markets recovered in Q2, bolstered by strong technicals, and as markets more broadly learned to adapt to geopolitical volatility. Now, the markets seem to be a bit bifurcated, though, as with non-AI assets in favored sectors winning really good terms. But as we're seeing a string of software credits and other names or more challenging names addressing 2028 maturities that are definitely being heavily scrutinized. Jessica and Scott, how have covenant terms evolved over the past few months?
Thanks, Kerry. I can start with this one. As you said, we really didn't have much going on in the first quarter in the leveraged loan space. But second quarter was a big change. And again, as you said, it's really been very bifurcated. We've seen opportunistic deals, a ton of repricings coming back. In those cases, the terms are really not changing. They're not getting tightened. The only thing that's really happening is, spread is getting tighter and you've got maybe call protection being refreshed. But really, any kind of performing or well-performing name that was able to reprice is likely to have kind of wider terms just generally. And if you're looking at a covenant review doc score basis, one strongest, five weakest, those tend to be kind of in the more flexible end of the range, fours and fives or ish. But we're also seeing a lot of new ADEs, for example, as you said, addressing this 2028 maturity wall, where some of those deals just may not get done unless the company accepts tighter terms from the market. And we've seen a lot more pushback and a lot more flex in those types of names. Tighter, more lender-friendly terms are coming in just to make sure that those maturities are going from 28 to 30 or 31.
Yeah, and I could jump in on that as well, Jessica. And I would very much echo a lot of things that you said there, Jessica, with Q1 being a little bit quiet on the high yield front. And in Q2, I think what we saw was a lot more issuer-friendly terms and a real resumption of that move towards more issuer-friendly terms, especially in the area of value leakage, which I think has been a long-term trend in high yield. For example, we saw a lot less pushback on aggressive terms in the second quarter. We saw an uptick in deals, for example, that had no ratio condition to access the builder basket. That went from around 20% of deals at the end of the year to over 30% of deals at the end of Q2 that had no $1 ratio debt condition to access the RP builder basket. That, of course, really does facilitate value leakage. It kind of takes away the guardrails, no gateway test to accessing any accumulated build-up basket capacity, which can facilitate drop-down spin-offs and LMEs. So we've just been seeing a lot of that. And the other thing I wanted to highlight is we've also seen a resurgence of this pick your poison investments concept, as we like to see it, as we like to call it, kind of a cousin of the pick your poison debt capacity, where you have this RP capacity that's already available for investments, and then you put a 2x multiplier on it and make it available for even more investments. So you start looking at that and you see some almost ridiculous numbers for unrestricted subsidiary investment capacity. For example, we saw the pick your poison investments concept in the Athena Health deal last week, and largely because of that 2x multiplier and the pick your poison investments, they're coming out of the gate with 8 turns of EBITDA can be moved into unrestricted subsidiaries on day one. And we've seen some other versions of that as well, perhaps with shared baskets, and a multiplier is buried in one of the definitions. We've seen a lot more baskets for the prepayment of sub-debt. Sub-debt is usually limited to payment subordinated debt, which really doesn't exist anymore. And it's just there because of the pick your poison concept, and it's sort of a dividend or investment basket in disguise. So we've seen these sort of sneaky drafting ways of ever expanding value leakage capacity.
Okay, so I'm going to actually jump back in here and talk a little bit, or kind of throw it back to Kerry. You had mentioned AI, which is obviously one of, if not the kind of biggest hot topic in the market these days. What's coming? Where are we? And how do we address it kind of across industries? So software risk, which we talked about in, I guess, in our last quarterly call, it's still very much top of mind to participants in the market. So we've seen some of these names in the last quarter come to market to do amend to extends. There's a lot of 2021 vintage software deals kind of coming to this maturity wall. So can you talk a bit about Imprivata, about Portability, about Proofpoint, and kind of what's happened in those documents and where have been some real pain points and negotiation points?
Certainly. So yeah, the first, I think, true software deal that came out of the gate was for Imprivata in June. And this is a software healthcare company. And documentation was a really key focal point of the negotiations. All of these deals have offered to increase spread, but in my conversations with investors, buttoning up the doc is top of mind. In the case of Imprivata, they either enhanced or added a lot of LME protections, tightened up numerous baskets and ratios, and enhanced MFN protection. And so that model and that deal got done in June, and it traded well on the break. Um, Papers now bid above par, I believe, versus issuance at 99. And so that one sort of set things in motion for more deals to come through. Cotality came also out with a significant wave of doc changes. Just to give some ideas, Imprivata, the covenant review composite doc score, it was the current deal was a 4.47, and as finalized, it moved to a 3.78. Cotality went to a 3.87 from a 4.24. LME protections were also a significant, part of the Cotality deal. And now we currently have a deal in market for Proofpoint, which is a cybersecurity company, also backed by Thoma Bravo, which, as is the case with Imprivata. And there's a deal for Sophos that is also expected to come out shortly. And in talking to folks on Proofpoint, documentation is again a focal point. The deal there also offers a spread increase from S plus 300 to 425 to 450. And there are also a bunch of doc enhancements, including enhancing FN, adding or enhancing LMEs, all buttoning up a lot of the criticisms that investors have of the current documentation. And I expect, there's a significant technology is the largest component of the 2028 maturity wall. As Jessica mentioned, this is born from 2021 when interest rates were super low. It was a really big year for LBOs. So there were a lot of tech LBOs during that era. And now the market is working through addressing these maturities. So that's something we've seen. Now I'm going to flip this back to you, Jessica, because Covenant Review has done some work drilling down into the covenants of several large sponsored LBO loans within software. How do they stack up as compared with the rest of the field?
I mean, yeah, we have looked at this, and this is not to say that, any of these are kind of ripe for LME or that we should be really concerned about a particular name. We should always be looking at the various terms in the documents, of course, and just to kind of see. And that's really where our focus was. And Scott can talk as well. They did a correlated analysis on the bond side as well. But what we're seeing just generally, I mean, again, 2021, low rates, lots of deals, big LBO market. And for software deals, they throw off a lot of cash. Like those companies are generally, they're based more on kind of a recurring revenue model where, they've got subscriptions and it's been very attractive kind of, historically to do those deals. A lot of those deals came to market, if I remember correctly, with really high leverage relative to some of the other deals that we've seen in other sectors, and just a lot of flexibility, again, because they're growth companies, to try and make sure that, the companies had enough flexibility to grow and expand and build new technology. So if you look at kind of those 2021 vintage and kind of, I guess, more recent software company names, they do have pretty flexible terms relative to the rest of even the pretty flexible sponsor market over time. In kind of a lot of different ways, just a lot of capacity for investments, a lot of capacity for debt incurrence in order to make sure that the company was able and is able to kind of move more flexibly and expand. One thing that I also wanted to note that I should have probably brought up earlier when you asked about some of these doc terms, we have started to see in a few credit agreements add backs to EBITDA for AI development and implementation. So this hasn't become, I wouldn't call it market quite yet. We have seen it in a few deals where it has cleared. In some cases, there are some parameters around, how much, what kind of a cap on an add back is appropriate, and we will continue to see these and have these conversations and see this term come into the deals, but just something to kind of keep an eye out for generally.
Yeah, I would very much echo a lot of those things that you said, Jessica, as well. On the high yield side, I think we have a very, very similar situation where a lot of these deals from the sort of 2021 vintage just have very, very loose terms, and we don't have any of these LMT blockers that we might see in some deals today. I think that they kind of go along with what I said before about a lot of value leakage capacity, and a lot of these names really are wide open for aggressive LMTs.
Thanks, both. And so speaking of LMTs, since 2021, there have been sort of some new ones that have emerged, whether it be Xerox or Ancora, or so sort of newer protections. How often are you seeing some of these newer protections added in new issue transactions? Is it just in thornier deals, or are you seeing it added sort of more broadly?
So I think it really, again, I feel like none of my answers are black and white. I'm a lawyer. Like, I just have to speak in shades of gray. So it really kind of depends on the deal, right? So yes, 100% in those thornier deals, in those ADEs for some of these more challenging credits, there are going to be much more stringent restrictions on what the company can do in terms of, as Scott was talking about, value leakage. So in some cases, we're seeing an overall cap on investments in unrestricted subsidiaries. Some deals, and this is more admittedly in the private credit space than we would see in BSL, might not allow for designation of unrestricted subsidiaries at all, or caps on intercompany investments, caps on intercompany debt, or requirements that any intercompany debt has to be subordinated in right of payment, kind of a double dip blocker, so to speak. We're actually seeing in a few deals, definitely the more thorny credits, what we're calling kind of an omnibus blocker, an overall blocker on whether or not the company can engage in an LME, which is very broadly defined to include a lot of different structural manipulation, so to speak, to kind of give the company some more wiggle room or alternatives to filing for bankruptcy or doing an outright restructuring. We are, though, seeing in a lot of kind of regular way deals, more performing credits, we are still seeing some of these blockers included and some of these restrictions. And I think part of that is because the market in some cases has been burned by not having those protections. So some of them are kind of, I don't want to say check the box, but definitely on the list of what people are looking for when a new deal is coming to market, to make sure that there is something in the document that will protect them against some of these more flexible transactions.
I think it's been a little worse on the high yield side in terms of blockers. We very rarely see Ancora or Pluralsight blockers or double dip blockers. And Ancora blockers you might actually expect to see more of, because we've seen the vote rigging tactic in high yield a couple of times, and Ancora was certainly not the first time we saw vote rigging with add-on notes. What you do sometimes see is a voting cap, but that's really a more sponsor-friendly term than a creditor-friendly term, because although there might be a cap on the amount that an individual investor or group can vote, the issuer is allowed to freely waive it whenever they want to. So it's kind of a lopsided provision that doesn't really operate as a blocker. In most high yield deals, you still don't even see a basic J crew blocker. It'll really be only thornier deals where investors have some leverage to push some changes through, and then you might see some of these blockers. For example, in the FMC high yield deal in May was the first time we saw a Xerox blocker in high yield. Of course, Xerox got around their J crew blocker by doing a JV with the lenders, so we saw a sort of expanded J crew blocker that applied to moving assets to non-guarantor affiliates, specifically to block that kind of Xerox transaction. So it's really, really been hit or miss in high yield. Most of the time, you're not seeing these blockers. And to Kerry's initial question, I think it really is the thornier credits and the situations where investors actually have some leverage to push back or dictate some terms that we start seeing a few of these blockers.
Thanks, Scott. So let's shift actually to a different topic in an area in which the buy side has actually been really successful in pushing back, and that's high watermarking. It remains a very hot button issue for the buy side, but deals, predominantly sponsored deals, continue to push this. And last week, just in the U.S. loan market, now granted two of them were cross border, but we had four deals last week that stripped out high watermarking during a covenant flex. It was ABB Robotics, which were run out of London, as well as two U.S. deals, both LBOs, Energy Solutions, and FDH Aero. While it's proposed in a small percentage of deals overall, in the year-to-date covenant data has it at 4%. It's actually been proposed in 32% of LBOs in the year-to-date. And yet it's removed every time. We haven't seen a deal clear, I believe, since October of 24. Jessica, why is the pushback so fierce in the US, and how does this differ from Europe?
So high watermark, just to kind of give a little bit of a setting of the stage, because I'm not sure everybody in the audience is aware of it, basically allows the company to use whatever the highest EBITDA generated over a 4-quarter period or an LTM period, depending on how it's defined in the document. That is going to be their EBITDA, literally high watermark. So if EBITDA ever declines, any ratios based on that include an EBITDA piece, any baskets that include an EBITDA grower, will be based on, and capacity and flexibility will be based on whatever the highest EBITDA is that was achieved over, a 4-quarter or LTM span, even if, again, EBITDA subsequently declines. So because EBITDA is so ubiquitous throughout the credit agreement, it's been a real pushback point, because if a company is not performing as well, the whole point of having, for example, an EBITDA-based grower in a negative covenant carve-out, for example, the greater of 50 million and 100% of EBITDA, and let's say on day one, EBITDA is 50. If EBITDA grows, the company is growing, they're performing well, they're doing what they're supposed to. Lenders are more comfortable giving them some more capacity, again, to continue to grow, to continue to expand. Whereas if EBITDA subsequently declines, that 50 that they started with is kind of the floor where they were most comfortable, or, they could get comfortable. The problem with the high watermark is that that flexibility stays forever and ever, regardless of what the company is doing. And as companies are going into distress, it still would allow the company to kind of maneuver, to pay dividends, to incur additional debt, to make investments, to, enter into these LMT transactions potentially if they needed to. And if they're not doing as well, then the likelihood that they will take advantage of these provisions is going to be higher, of course. It's been a huge pushback point in the US. As you said, we have seen it push back in European deals as well. The reason why I don't know why it gets pushed back more in the US. Maybe it's because this is one of those provisions that did develop and started in Europe and came over the pond in kind of the opposite direction of what we usually see aggressive terms doing, which is from US over to Europe. This one started in Europe and is coming over to the US. So I think the value of precedent can't be understated in this case. I mean, there are a lot of companies, sponsors that can come back and say, well, it's been in all of our deals. How come you're complaining now? Kind of thing. I'm just speculating here. Whereas on the US side, it started to come over in cross-border deals. We started to see it, a little bit more, I would say probably, summer of 2024 is when it really kind of came to the US via mostly cross-border deals again, and then in US only deals. And the reaction from the US market was, what is this? We've never seen this before. We are not enjoying this at all. And there was, again, no precedent for it really, other than in cross-border deals. So I think it was, I don't want to say easier to get out of the deals. I will say the other piece of this is that there are so many aggressive terms that are entering, in a first draft of a credit agreement that perhaps from the sponsor side, this is an easier one to give. And let go of, as long as maybe certain other provisions that are more important to the sponsor or to the company get to stay in. So there are probably a lot of reasons for this, but I will say that it is getting flexed out in European deals as well, although, perhaps not as often as we see it currently in the US.
Thanks, Jessica. Another topic that remains topical, I guess, is portability, which is something I know we've discussed before, but it remains relevant today. Scott, you want to talk about what you've been seeing in high yields as of late?
Sure. Thanks, Gary. And I think it's actually a nice segue. And Jessica previously just mentioned, often we see aggressive terms coming from the US and then going over to Europe, and it's rare to see it vice versa. But this is another example of an aggressive term that we often see in Europe that's very rare in the US. I mean, at high yield, change in control, leverage-based portability is very, very common in European deals and very, very far off market in the US. But it does seem like every few years or so, we see a push by sponsors to try to get change control, leverage-based portability into their deals. And we were at a point where it was really trending down, and change in control portability was in less than 5% of US high yield deals. But it seems like we're at that point right now again, where sponsors are trying to bring it back. And we've seen change in control, leverage-based portability in three very recent deals now: Athena Health, Morton Salt, and Carix. And when we see portability in US deals, it is different and usually worse than the version that we see in Europe. Because it's been in so many European deals, there are some protections, some guardrails that have developed over time. Typically speaking, to use portability, some deleveraging is required. Usually the leverage test is set lower than opening leverage, so some deleveraging is required to use it. Typically, the portability exception is allowed only once over the lifetime of the bonds, and sometimes it resets the restricted payments builder basket when portability is used. When we see it proposed in US deals, often those guardrails are missing. So, for example, in last week's Athena Health deal, the portability test was set at 7.8 times, allowing 2 turns of additional leverage to be added to the credit, and portability would still be available. And it didn't have the one-time use protection, and it didn't have the resetting the builder protection. And similarly, but not as bad in Carix, the portability leverage test was set at 5.5 times, which allowed about 3/4 of a turn of additional leverage, still allowing them to lever up a little bit and portability still being available. And none of those other protections or guardrails were in that deal either. Morton Salt is a little bit better. Around a quarter turn of deleveraging would be required to hit the portability leverage test. And they do have the protection where the portability exception is available only once over the life of the bonds. But to the point, when we see it proposed in the US, it's missing a lot of these market developed guardrails that we see in Europe, making it a really much more aggressive version of portability than is even common in Europe.
Thanks, Scott. I can discuss loans a bit too, because loans, unlike high yield, portability has been, save for some brief pockets of portability. Brief pockets of volatility, wrong word there. Portability there's been a significant push for it over the past 2.5 years or so as sponsors have been gearing up for a sale. And so we've seen it added in quite a bunch of deals, both in 24 and 25 and continuing in 26. Most recently, I think the most recent one is the Morton Salt deal that's currently in market. The Athena deal as well. The bond deal came along, a fungible add-on to the loan, but it wasn't the original loan that had been done back in May as an A&E. Interestingly enough, that was a rare instance in 2022 when the LBO loan, it was done very early in the year before the Ukraine war started. So market conditions were still very strong. That actually cleared with a portability provision in an LBO loan. So we see them added later on as the sponsors gearing up for sale, whether like the Morton Salt deal right now that's a dividend recap. There was also a deal for IQEQ that recently cleared with it. I think it was off European docks, but it's a cross-border deal. And in that instance, the sponsor, Astorg, has owned the business for 10 years. So there was that one. It was taken out of, and this was an unusual, the Energy Solutions LBO also had proposed a sort of ratings-based portability that's kind of more common in the energy world, but that was actually removed during syndication. But we saw this in Q4 too. There were a quartet of deals, the Athena deal that I mentioned earlier, a refinancing of a private credit loan for Modern Aviation, as well as 2 cross-border deals, TMF and Selena, that cleared with it. So this is something we see from time to time come through, but it's it's something that remains topical as we go forward. Some of the deals, the terms of them and vary a bit. I feel like a couple of years ago we had seen, last year in 24, we saw some issuers baking in the potential for a lot of headroom relative to closing leverage. I don't feel like as of late we've seen on, thresholds that are that aggressive. I suspected personally that I think, when rates were very elevated, that maybe, the sponsors were hoping that if rates declined, they could kind of, put a little more leverage on the businesses if, they wanted to sell them. Jessica, do you want to speak at all just to sort of some of the broad terms we're seeing? I will point out here also that LFI does track portability. And so we have a loan portability, and we do have on our website a spreadsheet with all of the terms of the deals that we've tracked if clear. So I'm going to pass it over to Jessica now.
Yeah, sure. What we're seeing on the loan side is pretty consistent with what Scott mentioned that they're seeing in terms of terms on the bond side. There are fewer guardrails, and I'm not talking about any specific names here. But we are often seeing, rather than having, a 12 or 24 month period during which the portability can be used kind of like ad infinitum until the end of time, maybe can be used more than once. Leverage, no leverage guardrails, no ratings guardrails. But I will say, though, that it really depends. Again, I feel like I'm a broken record. It really depends on the deal. There is no kind of standard set of portability terms. So we might see guardrails in one but not in another, or certain provisions or restrictions in one that aren't in another, or it really kind of varies pretty widely. And we actually have a report that was put out in early April that takes a look at, again, not naming names, but kind of categorizes the different restrictions, provisions, et cetera, in portability that, you know, I think it was from January 1st, 2025 through Q1 of 2026. Kind of, I don't remember how many deals we had looked at there. But as Kerry said, it's kind of one of those things that comes in fits and starts. If it clears in one deal, we see it in 3, 4, 5, and then it goes dormant and then comes back. And I think, right now, again, with, sponsors that are looking to exit, this is kind of a good way for them to potentially do that.
Thanks, Jessica. Scott, want to just touch on something you discussed earlier around increasing flexibility for value leakage. Are there other covenant trends in that area that you'd like to highlight?
Yeah, there are. Thanks, Gary. I think that we have been seeing this trend of increasing capacity for value leakage, and I think there's a subtle drafting change here that's going a little bit unnoticed that is really adding a lot of flexibility that maybe folks aren't appreciating. And that's what we call the no worse leverage test flexibility. And when you think about this in the RP and investment context, it really can add a lot more flexibility. So if we back up here, if we go back 5, 6, 7 years, not even every deal had a leverage-based carve-out in the RP test, right? Just the carve-out that says if leverage is not higher, then you can make any RPs you want. But, that's in every deal now. And now most deals have an investment-based leverage test that's set a little bit looser. But what we're seeing recently is more and more deals say you can make restricted payments or you can make investments if you can hit this leverage test, or the leverage ratio would be no worse pro forma. And on its face, that kind of sounds okay. Well, leverage is getting worse. But if you dig into that and think about what it's doing and why it's there, it really can add a lot of flexibility. And to explain the flexibility that it can add, I like to go back to the PetSmart Chewy situation from a number of years back. So just very, very briefly, what you had there was, PetSmart was LBO'd and they wanted to acquire Chewy, and they added a whole bunch of debt to PetSmart credit to finance the acquisition of Chewy by PetSmart. Fast forward a couple of years, PetSmart wants to spin off Chewy. And there was some litigation that ensued. And one of the big issues in the litigation was, look, there wasn't a leverage-based RP test and there wasn't a leverage-based investment test in a deal of that vintage. So they had to rely on the RP builder basket and whether they could meet the $1 ratio debt test based on 2 times fixed charge coverage was a big issue that came up in that litigation. And I mentioned the $1 ratio debt test earlier, and it's probably not a coincidence that following the PetSmart Chewy debacle is when we really started seeing the $1 ratio debt test go away from the restricted payments covenant, where some sponsors took note and said, hey, this is making it harder for us to pay ourselves. Let's just get rid of that term altogether. Anyway, point being, Chewy was an extremely valuable growth business, but was negative EBITDA at the time. So if you have this no worse test, you spin off or drop into an unrestricted sub, a negative EBITDA business, well, leverage is no worse. In fact, leverage is probably better because you're removing negative EBITDA. So you're really opening the door for spin-offs just like that. Whether you have, a negative EBITDA growth business or a growth business that's pre-revenue, or you can probably structure a transaction for leverage to be no worse if you're moving some debt along with the SpinCo, or with all the gamesmanship that goes into ratio calculations these days. The no worse test might not be that hard to meet if you get a little bit creative with the deal structuring. And we've really seen this in a bunch of deals recently. I mean, just to name a few, again, Athena Health keeps coming up because it's just super, super aggressive. It was, recent deals. There was also in Ancestry, Castrol, Gentiva, even Getty Images, even though there's a little bit of distress there, still had this no worse flexibility. The only deal that we saw it flexed out in was a CDNR deal called Sealed Air. And I think the only reason that it got flexed out in that deal is it was just so obvious. They had a very specific carve out that allowed business line spinoffs if leverage was at a certain level or no worse. So it was just so obvious that they were looking for spinoffs. But at the same time, any restricted payments or investments leverage-based test with a no worse qualifier is going to get you to the same place. And I think that this is one that a lot of folks are probably a little bit asleep on. And so then to shift gears a little bit on high yield trends, Kerry, there have also been recently a handful of examples of sponsors seeking more lax call protection in high yield. Can you walk us through some recent examples on that?
Sure. So yeah, this is, I think all the deals that I'm going to reference here are sponsored. But Venetian, in May, which is backed by Apollo, revised. They had originally proposed a 7-year non-call 3, the standard, and then shifted to a 7-year non-call 2. And that was the second deal this year. Hillenbrand and its LBO by Lone Star did the same thing in January. I believe both deals were very heavily oversubscribed, and they had the ability to shift this. Also over in Europe, there was a deal for Capsugel that also tried for 7-year non-call 2, but there was pushback and it landed at 7-year non-call 3. Also, when you look at some of the shorter tenor deals, there were also 2 deals in Q2. Dealer Tire, which was 5.25 years non-call 1, and Yahoo, that was 5-year non-call 1. And so this is sort of another area in which sponsors are just sort of pushing the envelope a little bit away from, the norm. And I think it's interesting. I mean, some of the names will be thornier credits, but there is an expectation, and we've seen it already. The Totality refi that was done more heavily weighted the cap structure to high yield. Ancestry is in market now with a bond deal that helps refinance firm debt. So I think there is an expectation that we're going to see more sponsored bond deals. Work on these addressing upcoming maturities because the exposure in the loan market to tech software is higher than high yield. So now whether some of the trickier names will be able to get off market structures, remains to be seen. Although one of them, the Yahoo deal, was an example of what had been a loan only structure, and then the sponsor came in and did do a bond there. So that's sort of another interesting trend that we've seen as of late. Shifting gears again, a big trend in high yield as of late has been the surge in data center related financings. This represented some 25% of the 100 billion high yield issuance in Q2. And these deals have continued to come to market, even though there's been a little volatility in the space, shall we say. These deals are pretty different, though, than corporate high yield bonds. What are some key themes you've seen thus far, Scott?
Sure. Thanks, Kerry. I think that's right, that they're very, very different than traditional high yield deals. When we talk about the covenant structure and the deal structure, and just to run through some of the key differences, very, very quickly, in these deals, we're really talking about the single asset SPV structure versus the sort of traditional corporate structure. These data center deals are really, bankruptcy remote SPVs that are focused on a single data center asset, which is, of course, totally different than our regular high corporate based high yield deals. And in terms of the legal terms and covenant protections, what we see is a lot of project finance mechanics that we typically don't see in traditional high yield. All of these deals have a defined cash waterfall and strict requirements for a debt service reserve account, which is, basically unheard of in traditional high yield, really project finance mechanics. And for covenant flexibility, additional debt and restricted payments capacity is typically strictly tied to project metrics. You don't have EBITDA or leverage tests like you typically do in high yield. So that's really, really different in terms of how the covenants work and what they can do in terms of additional debt and restricted payments. But I think probably the biggest central difference is that the data center lease kind of acts as the central covenant, right? Even though there might be debt liens and restricted payments covenants that kind of look like high yield covenants, if you look at them really, really fast, they'll all have carve outs that say, you can do anything permitted by the transaction documents which includes the data center lease. And there might be some description of the data center lease in the OM, but we don't have the full document. And it's the kind of thing that, high yield lawyers and regular way high yield market participants are not really used to thinking through. But it really is all focused on the data center lease. And if something happens with the data center lease, or they were to breach it, or to go away for some reason, there are mechanics in there to make it a default under the bonds, mandatory redemption of the bonds, and all those kind of things. So rather than your traditional covenant protections, it really, really is focused on the single asset and the data center lease. So question for you, Kerry, and for Jessica, the broadly syndicated loan market has also started to see a few data center related financings. What are some interesting features in those loans versus traditional BSL?
Thanks, Scott. Yeah, so we've seen a handful of deals as of late. We've so far there's been four, two from NeoCloud, CoreWeave, one for QTS, and sort of another deal that was done on a private lender only basis for CyrusOne. And as you mentioned, it is interesting because these deals do have debt service coverage ratios, which kind of reminds me of some of the project finance. Like we have a bunch of assets like within the PJM space that also have this covenant. So I definitely noticed that. Other interesting features, like if you look at, they have like the CoreWeave deals, both of them have, amortization profiles that are outlined in the way they're expected, so that the loan's actually supposed to be repaid, by maturity, which is very different than the standard 1% annual amortization that is in the loan market. So another thing I'd point out, going back to call protection here, is that, both of those, the CoreWeave deals are non-call 102, 101. And so that's very different than the standard 6 months of 101 soft call. I believe the QTS deal was 12 months of 101 soft call, so not quite as stringent. But in general, I mean, it's interesting because away from even the covenants, you just sort of have to assess, like the way investors assess these deals is just very different than your regular leverage loan. For example, there's two CoreWeave deals in market. And I was talking to someone and they're like, well, yeah, it is CoreWeave, but you sort of have to look at, who the contracts are with. It's not the same as, Athena Health does a loan and then it does an incremental loan. Well, it's still the same company. These are not exactly, there's a lot of devil in the details that people need to go through. And it's a different kind of, risk assessment. One other interesting thing before I pass this off to Jessica, there was the QTS deal had, and I believe it was subject to a 1.28 times debt service coverage ratio, but basically the collateral pool could rotate, which is, I don't think it's a new concept in finance, but it's sort of a different kind of thing for a lot of loan investors. With that, I'll pass it to you, Jessica. What have you noticed here?
Yeah, so as you've said, Kerry, there really are fewer of these deals in like the more traditional broadly syndicated institutional term loan B space. We do see them, and we don't do a ton of reviews of kind of more standalone pro rata deals, but we have seen some of these data center financings there. They are more project-y in nature, as Scott said. We've seen, and again, we expect to see variation here depending on, some of them are based on, the financing of the actual building and the construction of the project. Some of them are more then kind of morph more into, once revenues are being generated by the project, once it's fully operational, then the covenants might change. The point that you just made on QTS almost seems more like an ABL type financing where there's a borrowing base. And as long as, the borrowing base can be met, then certain items of collateral may not have to be in the collateral pool, or there can be, certain, different types of collateral might move in and out of what the basket might be, just as long as we're making sure that, all of the debt can be serviced. So these are, it's interesting. It is really interesting to see these kind of coming into the institutional term loan market. because they do feel a lot more project in nature or more ABL in nature. So I'm personally really interested to kind of see how these go and to kind of expand what we're looking at on the covenant review side so that we can, become more expert on it and be able to advise more. But yeah, as you said, it is a very just determining whether or not to be part of these loans is a different kind of risk calculation than what you would do in kind of a more traditional cash flow deal.
Thanks, Jessica. And now we would be remiss if we did not discuss on the special situations, the stress front. One of the interesting developments during the second quarter was Optimum. Jessica, can you walk us through what happened here and the potential implications for the market?
Yes, I am always happy to talk about Optimum. So Optimum Communications, formerly known as Altice USA, formerly known as CSE Holdings, kind of, the was Cablevision back when I was growing up on Long Island. So the latest and greatest innovation that we've seen out of Optimum over the last 6 to 8 months, the company created an additional unrestricted sub, which is now at this point raised $3 billion in term loans. One of those term loans was used to take out an SPV securitization style term loan that they had at another unrestricted sub, as well as the term loan 6, which was the tightest term loan in the CSE Holdings credit agreement, which freed up more flexibility under that kind of more, traditional OpCo restricted group credit agreement. One of the questions that we actually got that came into us on the covenant review / CreditSights side of things, since the implementation of that unrestricted sub, which by the way holds the East assets, which are kind of the more highly valued assets, I guess, whereas CSE Holdings retains the West assets, which are not as growth oriented, I guess, for lack of a better description. One of the questions that we got was, if the company were to file for bankruptcy, what would happen with any kind of returns from those unrestricted subsidiaries? Like, would those flow up to the CSE Holdings creditors at the kind of traditional restricted group where I think it's about $22 million worth of debt at this point, across term loans, revolver, guaranteed notes, and non-guaranteed notes. Also important to realize and recognize here that the only collateral that CSE Holdings lenders have is an equity pledge of the guarantors and entities, restricted subsidiaries at that group. So really a valid question. Okay, well, what happens if that company files for bankruptcy? Are these valuable assets both at this Litchfield subsidiary, the unrestricted sub, as well as there's a 50.01 ownership stake in the Cablevision Lightpath unrestricted subsidiary JV? What happens to those assets? Like, will any remainder kind of flow up to the CSE creditors? The answer to that was really unclear. We hadn't seen a real org chart that kind of goes into a lot of detail in probably several years. So what the company did in Q2 is they created another unrestricted subsidiary below CSE Holdings, which is a holding company for the unrestricted subsidiaries that already existed. So effectively, that kind of locks off any of the possible remaining residual equity value kind of flowing up to CSE Holdings to service that debt if the company were to file. So it's a really interesting and interesting development. I mean, we have articles written on this by my colleagues on the CreditSights side, kind of going through what do we think the possible implications of this are. I mean, could range from fraudulent conveyance claims. It could be unwound, possibly, who knows? They issued some equity out of that entity preferred, out of this kind of unsub blocker co, for lack of a better description. So this is one where we are watching very closely. One of the questions also is, is this a negotiation tactic on the part of the equity holders at Optimum to kind of get all of the creditors back to the negotiating table? They do have their first maturity under the CSC document is, I believe, April of 2027. So they really have to kind of figure out what's going on here. So that one, I guess, stay tuned. We will be very much on top of it and focused on it. They also just at the beginning of June did another $250 million of debt at that Litchfield unrestricted subsidiary that already had the $3 billion. Forgot to mention that. So again, stay tuned. And with that, I think we are at time. So really appreciate everybody joining us. So on behalf of Kerry, Scott, and me, thank you. And feel free to reach out to any of us with any questions. If you have any, there will be a recording available of this, I think probably in the next 24 hours or so. I'm not 100% sure, but be on the lookout for an email that includes a recording. And we will see you next quarter. Thank you.